Welcome to the deep dive. Today we are cutting right through the noise to give you a strategic shortcut into value investing in action.
That's right.
Our sources are all focused on one thing, the Q3 2025 portfolio of the Rule 1 Fund, which is managed by Philtown.
Right, and our mission here is to really move beyond the textbook stuff. We're looking at how a highly concentrated, conviction-driven strategy, what they call Rule #1 investing, how it actually decides where to put its money. This isn't theory, this is real capital, making some very calculated high-stakes moves.
And before we get into the stocks, let's just quickly define that philosophy, because it really underpins every single trade we're about to talk about. Rule #1, it's rooted in Graham and Buffett, and it uses this simple but really powerful tool, the 4M framework.
The 4Ms, it's the filter. It's what forces the discipline. You start with meaning, do you deeply, and I mean deeply, understand the business.
Right.
Then you've got moat. Does it have a durable competitive advantage that just keeps everyone else out?
Okay, so meaning moat. What's next?
Management. Are the people in charge trustworthy? Are they talented? Do they care about shareholders?
And the final M, which is, I think, the most critical for any classic value investor.
It is margin of safety.
The big one.
Exactly. You find that wonderful business, using the first 3 M's, and then you wait. You wait until it's trading for way less than what it's actually worth.
And that price cushion, that's your protection.
That is your margin of safety. It protects you from mistakes, from volatility, from yourself sometimes.
So when we look at the snapshot of this fund, the first thing that just jumps out is the sheer conviction.
Oh, absolutely.
It's holding only 9 positions, total market value about $217 million.
Yeah.
And the top 5 holdings make up almost 87% of the entire portfolio.
I mean, that is not diversification.
No, that is profound belief.
It's the ultimate expression of it. They are betting big, and I mean big, on their absolute best ideas.
And here is the core story of Q3 2025. This is the real aha moment. The fund didn't just tread water. It executed a massive strategic pivot.
A huge one.
They liquidated 5 positions. And these were high-quality names like Alphabet, GOGL, PayPal, Ulta Beauty, and they did it to fund one
Singular massive purchase.
Yeah, 143.88% increase in their position in Lululemon Athletica, LULU.
And that action is the perfect living demonstration of Rule #1. You sell good companies that are fairly valued to go all in on a wonderful business that has temporarily gone on sale.
So we're going to break this all down by strategic intent. Let's put things into 3 buckets. Strategic patience, opportunistic action, and then the core compounders in special situations.
Sounds good.
Let's start with the source of all that power. Pillar 1, the engine of strategic patience.
Right. And if you want to understand the manager's mindset, you just have to look at this one number, 46.46%.
Almost half the fund.
Almost half. Over $101 million is just sitting in a government money market fund. It's basically cash.
Which to a lot of investors, that looks like hesitation. It looks like you're sitting out of the game, especially if the market's running hot.
And that's the classic mistake, right? This is actually the highest form of discipline. It is an active investment decision. This huge cash pile is the purest expression of M4, margin of safety.
The rule is don't swing at every pitch.
Exactly. Don't swing at a fair pitch when you know you can wait for a fat one. This dry powder isn't lazy, it's potential energy. It gives them the optionality to act decisively when a crisis hits.
It's also a loud and clear statement that the manager thinks the overall market is, well, probably overvalued.
It is.
And if you're listening to this and you're wondering, how can I monitor that for my own decisions? That larger context is so vital for applying that margin of safety idea successfully.
Absolutely. Understanding the big picture tells you when to hold cash and when to load the cannon. And to track that total market temperature and to get daily updates, we highly recommend checking out the iOS app Buffett Indicator.
A Buffett Indicator.
Yeah, just search for it and download it from the Apple App Store. Monitoring that metric is how you know when it's time to act, just like the Rule 1 Fund did this quarter.
Okay, so from patience to aggression. Once that cannon was loaded, where did they aim it? Pillar 2, opportunistic action.
The fat pitch.
The massive swing at Lululemon, LULU, which is now a huge holding. So why? Why was Lululemon suddenly on the bargain rack?
Well, the stock had just collapsed. It was down over 45% for the year. The entire narrative was broken.
What happened?
Management came out and admitted that their U.S. lifestyle lines had, and I quote, become stale, And then on top of that, they got hit with an unexpected $240 million tariff headwind.
Ouch. So the market saw a catastrophe.
The impatient market saw a catastrophe and ran for the exits.
It really sounds like a classic falling knife scenario. How do you justify buying a stock that's crashing because of management issues? I mean, where's the safety against just poor execution?
That's the key question, and that's where their 4M counter thesis comes in, specifically moat, M2. The fund looked right past that temporary noise.
Yeah.
They assessed the core quality of the business. Lululemon has an incredibly wide moat based on its brand, its pricing power.
And you see that in the numbers.
You see it right there in the financials. 60% gross margins, a massive 41.3% return on invested capital, or ROIC.
Okay, so for our listeners, what does an ROIC of over 41% really tell you about a company's competitive advantage?
It means for every single dollar of capital they have in the business, they are generating an incredible 41 cents in profit. That is a sign of immense efficiency, of brand dominance.
Something a generic retailer could never do.
Never. And when a company has that kind of financial firepower, the fund can make a bet that these problems, like stale products, are temporary and, more importantly, fixable management issues, an M3 problem.
And the international growth was still there.
Still accelerating, up 22%. So that story was completely intact.
Which brings us to M4, the margin of safety.
The market panic created what they saw as a once-in-a-decade opportunity. Their own models, their DCF models, suggested an intrinsic value around $255.
And the stock was trading where?
At $177. So you had a built-in 33% margin of safety. That LULU trade is the perfect playbook. Liquidate assets you like but don't love to go all in on an asset you love when it's on sale.
Patient, yet opportunistic. Okay, let's shift gears now to the bedrock of the portfolio, the core compounders. Pillar 3. These are the wonderful businesses they want to hold for the long haul.
Even if they're not on deep discount.
Exactly. Let's start with ASML.
ASML Holding, a 3.16% position. This is the definition of a technology toll booth.
A toll booth, I like that.
The moat here, M2, is absolute. It's a 100% monopoly on extreme ultraviolet lithography machines, EUV.
And just remind us why that monopoly is so powerful.
Because EUV is the one indispensable technology you need to make the most advanced microchips in the world. No one else can do it, period.
You're not getting a deep discount, but you're buying certain.
You're buying certainty, and that certainty is backed by an astounding 55.5% return on equity.
And ROE, just to clarify, that measures how efficiently a company uses shareholder money to make profit. 55% is.
It's world-class capital efficiency, so they are more than happy to pay a fair price for that kind of compounding.
Okay, then there's Netflix, NFLX, their largest equity holding. Over 20% of the fund.
A massive position.
That's some serious faith in the content kingdom, but wait a minute. If you look at the financials, traditional DCF models suggest Netflix is significantly overvalued at its Q3 price.
Yeah, around $1,198.
Doesn't that just fly in the face of the whole margin of safety principle?
That's the essential challenge with this holding, and it shows their flexibility. It's a pure conviction play on the durability of the moat. They call it the scale-driven hit flywheel.
Explain that.
You have 277 million paid members funding an $18 billion content budget. That budget creates more hits, which attracts more members, which funds a bigger budget. It's a cycle that rivals just can't break into.
So they're betting on the value of that moat over a cheap price today.
Exactly. But they aren't just chasing it blindly.
Right. They showed discipline earlier.
They did. They trimmed shares back in Q2 when the price was even higher. So they're managing the position, they're holding a long-term compounder, but they still know when the valuation gets a little too hot.
Okay, let's pivot to two companies that are really transformation stories. Occidental Petroleum, OXY, and Howard Hughes, HHH. Let's do OXY first.
Occidental, which is a 5.65% position, is fundamentally a debt repayment story. The moat is there. They have Tier 1 assets in the low-cost Permian Basin.
Yeah.
But the real thesis is M3 management.
Defined by deleveraging.
Relentless deleveraging. They repaid $7.5 billion in debt in just 13 months. That kind of aggressive action is just pure value creation for shareholders.
But the stock price still seems to reflect that old debt-heavy story.
Correct. And that's the M4 thesis. The market is pricing OXY for the company it was, not the deleveraged cash flow machine it's becoming. The numbers suggest it's about 36% to 41% undervalued right now.
And Howard Hughes Holdings, HHH. This one feels like a pure management bet.
It really is. HHH, a 5.66% position, is built on the idea that its master plan communities, or MPCs, are irreplaceable. Think of the woodlands.
These giant self-sustaining cities, basically.
Right. They create this geographical moat and incredibly stable, predictable cash flow.
Yeah.
But the transformation, that's the M3 genius. This is a bet on Bill Ackman.
Ackman's plan to turn it into a modern-day Berkshire Hathaway.
That's the goal.
Yeah.
He's using the MPCs as the cash flow engine, the float, just like Berkshire uses insurance float to fund future acquisitions without having to go to the market for capital.
So if I buy HHH today, I'm getting the existing real estate, which is already undervalued. Plus, I get a free option on Ackman's future capital allocation skills.
You just distilled the entire M4 thesis. The stock is already 17 to 19% undervalued based only on the real estate it currently owns. The whole Ackman transformation that's basically being offered up for free.
A very compelling proposition. Finally, Pillar 4. The special situation. The fund holds Fannie Mae and Freddie Mac. This is the exception that proves the rule, right? These don't fit the 4M framework at all.
They do not. This is a purely event-driven asymmetric bet, a high-risk one. These companies, the GSEs, have been in federal conservatorship since 2008. The Treasury just sweeps all their profits away.
So the entire investment hinges on one single binary event, a political catalyst.
That's it. The thesis is that eventually the government will end the conservatorship and reprivatize these companies.
And the upside could be huge.
Immense. The current prices are speculative, maybe around $12 a share, but proponents suggest a reprivatization value could be $25, $34, maybe even higher.
So why would a fund so focused on conviction and safety hold what's essentially a lottery ticket?
It's a strategic allocation. Because the core portfolio is anchored by these high-quality compounders and that massive cash reserve, they can afford to take this calculated risk.
It's non-correlated upside.
Exactly. If it pays off, the returns are massive.
Yeah.
And it uses capital that wasn't big enough for that fat Lululemon pitch.
So what does this all mean when you put the strategic cash, the opportunistic action, the core compounders, and the special situation all together? What's the final picture?
I think the Q3 action was a definitive masterclass in strategic value investing. You had the massive patience of that 46% cash position, providing the firepower for the conviction of the LULU buy.
Right.
And that conviction then angers the core compounders, the quality businesses like Netflix and ASML, and it allows you to take calculated asymmetric bets like the GSEs. They showed that selling a perfectly good company like Google is not just okay, it's necessary when a truly great opportunity comes along.
And that strategy, it really hinges entirely on having cash ready when a temporary crisis hits a wonderful business.
100%.
Which brings us to our final provocative thought for you. We challenge you to look at your own portfolio. What percentage of your capital is truly dry powder, really waiting to capitalize on that next moment of maximum market pessimism, just as the Rule 1 Fund did with Lululemon?
Think about the optionality that cash gives you. It allows you to be the rational, aggressive one when everyone else is panicking.
Thank you for joining this deep dive.
My pleasure.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on Apple, Spotify Podcasts channel, Deep Value Investing. And to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store. Tuko star ipo shing chekeche ita tuko si adong janyu. Wahikosti ko donkono akamina. Chuku kanye suken janyu waipu kong kong ko hanyu. Choi kyu fang yu